I'm here with Adam Reisler, partner at StepStone Group. Adam, thanks very much for participating in the Inside Networks Alternatives Symposium.
Thanks, very happy to be here.
Great pleasure having you here. The fourth industrial revolution is reshaping infrastructure through digitalisation, smart cities, renewable energy, and there'll be all sorts of other concepts coming through. Where is StepStone currently seeing the most compelling opportunities in the infrastructure sector?
Well, it's interesting. We're actually seeing really compelling opportunities clearly in these mega themes that have huge tailwinds behind them in digital, around AI, data center and compute needs, energy, and the massive amount of not just generation but transmission that's going to be required to meet the needs of not just compute but also the electrification of households and industry in the US and Europe and around the world. So the mega themes are critical to what's driving growth in this space, but interestingly enough, we're still seeing opportunities in some of the more boring parts of infrastructure, some of the ones that are perhaps being overlooked in this current environment. We're seeing stuff in just sort of your traditional renewables. We're seeing opportunities in transportation where the sort of risk return proposition is probably more attractive than it's been in the last decade. So we like to play a broad sort of field, and we look at opportunities in different sectors and different geographies with different strategies on the big end of town and the small end of town to see what we think is the most interesting relative opportunity set.
If we think about infrastructure, it spans core plus, and value add exposures. So how should advisors, when they're looking at the sector, distinguish between those categories in terms of risk, return, and cash flow visibility?
Yeah, I think the market has expanded a lot in infrastructure. It used to be there was a handful of names, and really it was your sort of core infrastructure assets delivering pretty boring but consistent returns. And I think the market is hugely bifurcated now. It's great because there's a lot more opportunities, but it's obviously a lot more difficult to navigate. And I think you mentioned some of them, but we have things like opportunistic infrastructure, PE infrastructure. So the range is large, and I think investors who only have one or two allocations to infrastructure should try to find something that provides a balance, something that will provide them the downside protection that we like from the asset class, but provides them access to some of the growth and tailwinds that we talked about in these mega trends. So from our perspective, we're investing in a blend of sort of core plus value add opportunities that give that mix, which we have found to sort of produce pretty interesting returns with relatively low volatility over a large portfolio.
One of the most appealing things about the sector is when you get into the area of long-term contracted revenue and inflation-linked cash flows. To what extent do they genuinely protect investors in an investment and market environment like we have today?
Yeah, well, the thesis around infrastructure being an inflation-protected asset class hadn't really been proven out because certainly when I joined the space 15 to 20 years ago, we had a very prolonged period of no or very low inflation. But we now have this sort of data set to show that it's actually performed exactly as we had hoped. It's been not only a hedge, but actually it's outperformed in these high inflationary environments in the sort of 2022, 2023 period when we saw high inflation and most other asset classes have a drawdown. We had an increase in valuations across our portfolio in infrastructure. And when you actually look at the earnings of those assets, compared to 5 or 6% CPI, we had earnings growth of about 15 to 18%. So it was genuinely real pricing and revenue growth that resulted in earnings and valuation growth. And so I think that in an uncertain inflationary environment, it remains an asset class that will help a portfolio, relative to other parts that might be impacted by higher costs and higher interest.
As capital flows increase into private infrastructure, what are some of the valuation and governance risks that might occur that advisors really should be getting their heads around?
There's a lot of strategies out there now. There's a lot of different sponsors trying to do similar things, and I think you really need to be able to be equipped to assess the quality of the sponsors that you're working with, their ability to underwrite and drive value. Data centers is sort of the hottest topic now, but not all sponsors in data centers are created equally. Locations of data centers are not all the same. So from our perspective, it's knowing the track record of a sponsor, their ability to get connection to power, to get sufficient water, to have community buy-in, to get power generation to the site. So all those things are paramount to us. We make sure that we're not paying too much for the pie and sky growth. We want a solid return based on the contracts that we have in place and potential upside through growth in either that asset or through a platform. So from our perspective, it's being a bit skeptical in terms of overall valuations in the space, but finding the pockets that provide real value, which is being able to be selective essentially across a very large opportunity set.
So for advisors who are thinking about private infrastructure within a diversified portfolio, what would you say is the best way for them to look at it? Primarily a defensive income sleeve or a growth allocation or attributes of both?
Look, it is now a balance of both. And we're seeing this, the CIOs of some of the largest institutional investors have shifted their mentality about this being more of a fixed income plus asset class to being something that can produce interesting yield, but actually has a growth element to it. With almost if done well, also an asymmetric risk profile where you can get protection on the downside, but have a reasonably large upside potential, which is a pretty interesting proposition really when you add it to your portfolio. So I think what you want to do is invest in a very diversified portfolio if you can. You want to get access to different segments of the market, whether it be mega cap, mid-market, sector specialist managers, diversified managers. And if you can do that in a diversified way, you get access to some of these sort of mega trends at pretty interesting defensive characteristics. So I would say you'd want to position this as a blend overall, which, like I said, I think is now, it's meaning that the infrastructure asset class can play perhaps a different part for the portfolio than it used to be able to play.
So can you tell advisors a good story around uncorrelated returns?
Yeah, well, I mean, we continue to see the asset class be very uncorrelated to equities, but also to other private market asset classes. I mean, I think ultimately this is an asset class that by design should be sort of an essential service, a highly contracted cash flow that isn't going to deviate with big market sort of crisis moments. And so when you have this sort of stability or this low elasticity of demand, it's what produces this lack of correlation to other things that are happening in the market. And we've seen the data really play out about that correlation. So we finally have sort of enough of a data set, which is now sort of 20 years in the making in this asset class to show that has proven out alongside its other characteristics like inflation protection.
Adam Reisler from StepStone, you had a very interesting story to tell attendees. Thank you very much for your time today.
Thanks, appreciate it.